Hi, I'm Erin Bigley. I'm the head of Fixed Income Responsible Investing at AB. It's generally accepted that the integration of environmental, social, and governance, or ESG, considerations is important for equity investors, but what about fixed income? In fact, ESG integration and engagement is just as critical in the bond world as it is to equities. At AllianceBernstein, we weave ESG integration through our process, from bottom-up research to top-down portfolio construction and client reporting, because we believe this leads to better client outcomes. One challenge when incorporating ESG within fixed income portfolios is that there's so many dimensions. Different types of issuers, corporations, countries, municipalities, and securitizations, both investment grade and high yield in quality, located in both developed and emerging markets. When it comes to corporate bonds, ESG considerations are often quite similar to equities. And in fact, our equity and fixed income analysts often share research notes and do joint engagements. Analysts must determine what environmental and social factors are material to each issuer and industry, and must understand how well governed an issuer is. Understanding the environmental factors surrounding an issuer can lead to interesting opportunities in today's environment. Take, for example, Renewable Energy Group. Renewable Energy Group is a high-yield company based in the United States. They're a global producer and supplier of renewable fuels such as biodiesel, which is a cleaner burning replacement to petroleum diesel fuel, and an effective fuel for reducing carbon emissions. Biodiesel can be made from different sources or feedstocks, including plant oils, animal fats, used cooking oil, and even new sources like algae. The resulting renewable fuel is chemically identical to petroleum diesel and meets the same performance standards. Our thesis when owning bonds issued by companies like Renewable Energy Group is to gain exposure to issuers that are involved in a new generation of innovative, low unit cost, low emission energy sources, which will likely benefit from the secular tailwind favoring cleaner and renewable fuels. These businesses are also appealing targets for takeover by traditional oil and gas companies, as these traditional energy companies face pressure to decarbonize. And in fact, at the end of February of this year, Chevron, a traditional integrated energy company, announced that it would acquire Renewable Energy Group in order to diversify their operations and lower the carbon intensity in their operations. This then led to a rally in Renewable Energy Group bonds, providing a good example of how we can achieve positive financial impact through investments that tap into environmental opportunities. In addition to identifying opportunities, ESG analysis also helps manage risk. Our analysis shows that from 2016 through 2021, 2/3 of the worst performing credits in the JP Morgan Corporate Emerging Market Bond Index were those with weak ESG practices, ranging from fraud to environmental challenges to conflicts of interest and poor governance. As we look beyond corporate debt to other sectors like securitizations, we need to consider different ESG factors. Take, for example, the commercial mortgage-backed or CMBS market. One of the main risks to CMBS is permanent property damage, which might be due to earthquakes, hurricanes, tornadoes, wildfires, floods, or severe storms. This damage may not be completely covered by insurance, and overall losses can be substantial. Even when a property is insured, total losses for catastrophes almost always exceed insured losses, as we saw in some of the extreme events during 2020. The problem is significant and growing as climate change drives more frequent and more catastrophic natural disasters. And avoiding all loans with climate risk exposure isn't realistic in the commercial real estate sector. Instead, we assess risk for individual properties based on models that consider specific types of potential disasters region by region. Through this in-depth analysis, we can better understand the risk within each CMBS and either demand better pricing on riskier deals or avoid them altogether. Take, for example, a LEED certified property we considered in Florida in the United States. It was a transportation hub promoting rail service, encouraging less car usage and fewer emissions, a seemingly sound green investment at first glance. But we became concerned when we learned that the building owner had the right to drop their storm insurance coverage for any reason, and the loan agreement didn't have to require flood insurance since the building wasn't in a designated FEMA flood zone. We worried not only about physical damage to the property, but also the potential disruption to the tenants and their businesses, which hurts both current cash flow and future leasing prospects. Some investors might find these risks worth taking, especially for a LEED certified property, but in this case, we felt the valuation didn't compensate for those risks, and we passed on the investment. In fact, we find that there's little to no pricing difference based on climate risk in today's CMBS market. So by identifying environmental risks, we feel like we're getting a step ahead by choosing bonds that have less climate risk without sacrificing yield spread. At AllianceBernstein, engagement with issuers is essential to getting a comprehensive view of ESG risks and advocating for action to effectively manage those risks and support our investments. In South Africa, we've engaged with Eskom, South Africa's government-owned electric utility and the largest greenhouse gas emitter in the country, accounting for approximately 200 million tons of CO2 per year, around 40% of the nation's total emissions. AllianceBernstein joined the Climate Action 100 Plus engagement with Eskom as co-leader as a way to address our concerns regarding the company's climate risks. With such high emissions and the operation of 15 coal-fired power plants in South Africa, Eskom faces a significant undertaking to decarbonize. It must also contend with the social costs associated with shuttering coal plants and transitioning to renewable energy in a country where the unemployment rate is already well over 30%. AllianceBernstein and its Climate Action 100 Plus partners have established an ongoing dialogue with Eskom that considers the company's unique context and challenges, while also highlighting concerns over the transition risks of climate change and how they could impact Eskom's access to capital markets. This engagement has yielded several positive results. Notably, Eskom announcing in August 2021 that it will retire approximately 30% of its coal power plant capacity by 2031. The company also launched its net zero commitment with plans to further cut coal and pivot to renewable energy. Eskom is also expected to benefit from an $8.5 billion international financing commitment that will provide Eskom with funds to implement its decarbonization strategy. Speaking of innovation in the bond markets, we've seen a real explosion in ESG labeled bonds, where we can invest in bonds that finance green or social projects, or invest in debt where the structure is linked to an issuer's ESG targets, such as a coupon step-up if their target, such as emissions reduction, is not realized. Nearly $800 billion in ESG-labeled bonds were issued in 2021, accounting for about 1 in 4 investment-grade and high-yield new issues in Europe alone. We believe these bonds provide attractive opportunities even for mainstream bond portfolios, since they tend to exhibit strong technicals. There's not enough supply to meet the significant demand. As a result, ESG-labeled bonds tend to offer investors slightly lower yields compared to conventional bonds, the so-called greenium. We think the trade-off is worthwhile for well-structured ESG bonds when we consider their behavior. In particular, ESG-labeled bonds may experience smaller drawdowns in volatile markets, helping to buffer portfolio performance. Historically, the greenium has become more pronounced when volatility spiked and spreads widened, as they did in the onset of the COVID-19 pandemic, meaning ESG-labeled bonds saw less spread widening. But investors must beware of the potential for greenwashing in this newer market. And so developing a detailed understanding of each bond's unique structure is key. We have a proprietary framework to assess ESG-labeled bonds that asks issuers a series of questions in order to understand the strength of their approach. First, is the issuer involved in any ESG controversies? For example, is it an oil company trying to issue a green bond? If they're involved in controversy, we want to avoid exposure to the ESG bond. If not, we'll proceed with more questions. What are the projects the bond is funding or the targets it's trying to meet? And are they appropriate for both the company and its industry? And could the bond proceeds cause meaningful harm in any other respects? For instance, a proposed hydroelectric dam financed through a green bond may create severe damage to the local environment and communities. What's the timeline to deploy the proceeds or meet the target? We prefer to see impact sooner rather than later. And lastly, does the company plan to issue more ESG-labeled bonds down the road, contributing to a more robust ESG bond market? Or are they just riding the green wave of issuance with a one-off deal? We generally want to minimize exposure to ESG-labeled bonds from these issuers who answer questions unsatisfactorily. If the bond checks some, but not all boxes, we will treat the bond like a conventional bond, not an ESG bond. Whereas if the issuer resoundingly passes our tests, we consider it a well-structured ESG-labeled bond, and that usually means we'll be willing to accept a modest greenium in exchange for smaller expected drawdowns during periods of market stress. In conclusion, the benefits of ESG integration and engagement are not limited to the equity world. They lead to better client outcomes in fixed income too. And these benefits are not limited to ESG-focused portfolios. For conventional bond portfolios, ESG integration can help to identify opportunities and mitigate risks, leading to superior risk-adjusted returns. Thank you so much for joining me today.
Discussion of ESG integration is often limited to just bottom-up security selection and engagement, or it focuses on specific long-term secular themes such as climate change. It is also typically only considered and applied within public equity markets. As you will already have heard, these needn't be the case, and good ESG integration and engagement can and should be extended to fixed income for the benefit of our investors. Moving beyond integration at the individual security level, I'm going to discuss how the integration of ESG issues should be considered at a macro level as an asset allocator across stock and bond exposures, and beyond. By that, I mean that there is also the need to broaden these considerations to the full range of investment opportunities that are available to our investors, including areas like real estate, infrastructure, and commodities. As a multi-asset investor, our approach is to integrate ESG into a portfolio to deliver attractive investor outcomes, whether they be seeking capital growth, income, or to provide for a specific future event like retirement. Being responsibly invested requires us to integrate ESG at a top-down, macro level, whilst also maintaining that integration at an individual security or bottom-up level within our underlying security exposures. Failure to do this may inadequately and most critically inefficiently capture the financial opportunity it offers. For this reason, we seek to take a broader view on the secular themes that ESG seeks to exploit. By moving beyond a single theme and being more diversified, we can keep investors invested in these opportunities for the long term, whilst avoiding the short-term pitfalls that an undiversified approach can lead to. It also provides us with the scope and opportunity to rotate between these themes as the opportunities evolve within them. Now let's look at inflation. We believe that increasing focus on ESG issues is likely to be inflationary. This is easy to understand, as the necessity to replace cheaper ways of doing business with greener, more socially responsible ones will most likely drive prices up. Albeit we would argue that the economic benefits will outweigh this in the long run, with a wealthier, more productive and sustainable economy beneficial for all. The problem is that some approaches to ESG investing avoid natural short-term inflation hedges, such as commodities, whilst overemphasising long-term growth opportunities, often young companies that are more susceptible to the higher interest rates typically coinciding with short-term inflation spikes, as we are seeing today. Overcoming this in a portfolio does not necessarily mean giving up the long-term return opportunity associated with ESG integration. Here are some examples of the actions that we are taking. The first thing we have done has been to balance long-term growth stocks focused on our broad secular themes with stocks that benefit more immediately from these themes. That is, businesses that are already generating significant revenues from these themes. The second is to go beyond public stocks and bonds to find real estate, infrastructure, and commodity-related assets that are aligned with our secular themes and that meet at least 2 of 3 important diversifying criteria to traditional ESG integration approaches. Impact, recognizing that deploying new capital into new projects will potentially be a more attractive way of directly accessing and promoting these opportunities than that of traditional public equity. This may be via the IPO of a new investment company focused on developing projects focused specifically on our secular themes. Inflation, finding opportunities to provide a natural inflation hedge where their cash flows are in themselves linked to inflation. For example, this may be investment in residential property, such as social housing, or infrastructure, such as renewable energy, fibre optic broadband networks, or communications towers. Income, investing in assets already generating theme-aligned revenues for investors to offset the growth style or longer horizon cash flows bias commonly associated with more traditional ESG investments. We're also researching how carbon credit markets can potentially provide an attractive inflation hedge whilst also positively impacting the climate. The final piece is bringing all of this together into a single portfolio that integrates ESG not only from a bottom-up security selection approach, but also a top-down macro asset allocation approach. We focus on 3 things. Firstly, making sure that the need to manage overall portfolio risk does not come at the detriment of good ESG characteristics that we desire. We think it is important to recognise that every single security in a portfolio needs to sit within our ESG integrated approach and hence is subject to the scrutiny of our analysts. Indeed, too many ESG-orientated multi-asset portfolios end up with unfriendly ESG exposures resulting from a lack of joined-up thinking between the multi-asset manager and the security selection experts. One reason for this is the use of quantitative techniques such as index tracking or the data mining of backwards-looking ESG data that allow poorly aligned companies to fall through the net. Secondly, we look at risk holistically across the whole portfolio to understand the macro risks that a portfolio may be exposed to as a result of ESG integration. And we seek to manage these, as I have demonstrated in the examples I have given, around thematic diversification, where we ensure exposure across a broader array of secular drivers, and inflation protection. The final area of focus is transparency. This is about providing clear and useful reporting to investors that shows how this approach delivers best-in-class ESG outcomes as well as the attractive performance that we expect. Whilst a valuable tool in its own right, ESG integration is not just about bottom-up stock and bond selection and issuer engagement. The macro impacts of ESG on asset allocation needs to be considered fully in your investment strategy. Balancing asset allocation across a diversified range of attractive secular trends such as climate change, healthcare and empowerment, rather than narrowly focusing on a single theme, can allow investors to benefit from the long-term return opportunities they present without taking potentially excessive short-term risks. Most importantly, ESG integration should not come as a compromise to the risk that portfolios perform poorly in periods of high inflation. And mitigating this inflation risk should not come as a compromise to long-term risk and return benefits that good ESG integration can deliver. We believe that with an unconstrained multi-asset approach, one that moves beyond growth-focused investments into more balanced equity exposures, as well as fixed income and alternative asset classes, we can achieve this.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。